Good afternoon, everyone. It looks like we still got a few folks joining us, a big crowd today, but in the interest of time, we're going to go ahead and get started. My name is Jamie Terrell, and I lead marketing communications here at Saltmarsh. We're happy to have you here with us today for part 8 of our PPP webinar series. That's right, I said 8. Yes, we are still counting. If you are a regular guest of our webinars, welcome back. If you're here with us for the first time, you can find webinar recordings for any of our previous presentations, including PPP parts 1 through 7 on our Saltmarsh COVID Hub, which you see shown here on the screen. With us again today are 3 members of our COVID recovery and response team, Suzanne Cox, Glenn Scharf, and Andrew Kent. All shareholders here at Saltmarsh. We're happy to have them leading our presentation once again today. They have spent a lot of time reading new information, are excited to share with you all today. Before we begin though, I have just a few quick housekeeping notes to mention. First, everyone on the line has been muted. If you have questions during our presentation, we invite you to share them with us in the chat. You've got a Q&A feature. You're welcome to share those questions. I've got Glenn on the line with me, and he'll be taking questions throughout as well, so thank you, Glenn. You're also welcome to share your questions with us by email to ppp@saltmarshcpa.com, and someone from our team will follow up with you directly. You see that shown here on your screen as well. Today's presentation is being recorded, and you'll receive it tomorrow by email along with a copy of our slide deck. And finally, upon leaving today's webinar, you'll be prompted to complete just a very short survey. It should take less than 30 seconds in total to complete. Please take a moment to just let us know your feedback on today's presentation. If there are other topics you'd like to hear about, we really appreciate that input. With that, I'm going to hand things over to Suzanne Cox, shareholder in our audit and assurance practice, to get us started. Suzanne?
Hey guys, it's been a while. I feel like it's been a while since we've seen you, so we're pretty psyched to be here today, giving you round 8. As Jamie mentioned, we do have 7 previous ones that are on our YouTube channel for your viewing pleasure. Feels like it's been a while and didn't realize we'd be doing this for a second draw, but it looks like we are. So you guys are lucky you'll have us around for a little bit longer. All right, so we're going to dive in today. Here's today's agenda. We are going to do a high-level overview of the Economic Aid Act. We're going to talk about taxability. That is everyone's #1 topic right now, I think, is what's going on with taxes. I know you've been out there probably reading things, so we're going to talk about that a little bit. And then we're going to talk about first draw and second draw PPP loans. We're not going to spend a lot of time discussing forgiveness. As we mentioned, we do have 7 other webinars if you'd like to get some more information on forgiveness. And of course, you can always reach out to us and ask any questions that you have directly to us. So we are available to answer your questions, but we won't be spending a lot of time today on that. The apps right now for forgiveness applications have not changed. The allowable expenses have, and we're going to talk about those. And then we do expect some new guidance coming on the forgiveness piece of that. So again, that will probably be part 9. So moving right in, Economic Aid Act overview. So as I'm sure everyone knows, this was signed into law in December on the 27th. And what it does a couple things. It reauthorizes lending under PPP through March 31st. So what that means is if you missed round 1, if you were, I don't know, in Egypt, you didn't realize it was round 1, they have reopened round 1. So if you missed out on the first time, you do have until March 31st to apply for round 1, okay? Modified provisions, we're gonna talk about those. So what's changed to round 1? They did make some changes, and not everything is exactly the same. Also, it authorized second draw loans. And so if you got a first draw loan and you went through it, you spent it all, and now you can get round 2. So that was part of the act, is to authorize a second draw. And as you can see, it was big dollars. So those are a lot of zeros. That is $1 billion. It includes $280 billion in new money. So there is quite a bit of money out there. We know a lot of people are excited to get to get going and get applied. Right now, a lot of the banks, at least the ones we know of, are not accepting applications for second draw loans as of yet. I'm sure you've read or heard as of January 11th that SBA was open, but that doesn't, mean that their banks are open. And so the banks are still, again, scrambling to get things together. And so, be patient, be in communication with them to find out when your portal will open for the second draw. Like we said, most of the ones we've talked to have not opened quite yet. But there is a lot of money out there. So as the first round came out, nobody really knew. There's a lot of just unknowns at the time. And so everyone was rushing to get in to make sure that they got in before the money ran out. This one is a little more civilized, maybe. And the SBA has came through and given guidance on the date that they said they would give guidance. And so it appears so far that things are working a little more slowly and a little more calculated this time around. So that's great. So as I mentioned, our first exciting topic is taxability. So I'm going to pass that over to Glenn.
All right, thanks, Suzanne. Yeah, I know, just following up on that bank, that Hancock Whitney, Trustmark, and Regions all said next week before their portals will be open for applications. So let's talk about PPP and taxability. This has been a long time coming. From when the IRS said that this is non-taxable income and that then the expenses would not be deductible, we have been waiting for that to be fixed. And so with this new act, they actually fixed that. So the forgiveness of the PPP funds will not be in gross income for tax purposes. Then what they did was they said, okay, but we're going to make all the deductions, deductible expenses as if you paid them. So all your payroll, rent, whatever you use to pay your PPP funds, to use your PPP funds, all of that's going to be deductible. Now, a couple of things that, typically happen with cancellation of debt income, things like that, aren't going to take place here with this scenario. So typically, the tax basis of your attributes. So for example, if you had a capital loss carryover, a net operating loss carryover, let's say you had an NOL for $100,000 and your PPP loan was 90. So they would actually typically make you reduce that $100,000 NOL down to $10,000 because you had this forgiveness income. Okay, they're not making you do that here. So that's really good news that we don't have to double dip. The other thing is, for all the partnerships and S corps out there, that the forgiveness is treated as tax exempt income. So it will increase your basis in your stock or your partnership units. So that's really good too, because otherwise you might have had basis limitations with all these losses and extra deductions without the corresponding quote unquote income that we're getting from a tax-free standpoint. So that's really been great news, I think, for everybody. It's been a big sigh of relief for everyone. And that's really what Congress had intended from the very beginning.
I mean, at this point, I don't know what anybody's going to email me about since this came out. I mean,
well, we still got fuel to talk about.
That's true. We're not there yet. Quick note, not to confuse everybody, but Glenn's our tax person, and I'm more of a GAAP person. And so just a comment here on GAAP. And so
yes,
for GAAP purposes, this will be income for GAAP. Now, just a note here is that they are different. And so GAAP means your financial statements or your book, book financials, your internal financials. And so for that purpose, this will be income, but for tax reasons, it will not be. So just wanted to point that out there.
Yeah, Suzanne, and likewise, if you're a healthcare provider and you got money through the CARES Act, the provider relief funds, this is going to be income, part of the total revenue for CARES Act purposes too. So yeah, big distinction here between GAAP and other accrual reporting functions and tax.
Definitely, it can be confusing. So just know there's a difference there. All right, Glenn.
Great. All right, so let's talk about other notable tax changes. So first of all, we've got some of these credits that were created or extended with the original law. So here we've got some updates for payroll tax credits. The employer credit for Family and Medical Leave Act, those have been extended through 2025. So that's really great news for those that are taking off for those purposes. The Retention Act, the Employee Retention Tax Credit, this has been a very confusing credit for some, especially with the new forms and things like that. But they've really done us some favors here by extending this Employee Retention Tax Credit through June 30th of this year. Employers who receive PPP funds can still qualify to take this credit even though you got a PPP loan. That's a change, okay? Originally, if you got a PPP loan, you couldn't take the credit. But now what they're saying is, as long as you're paying people without PPP funds, so then you'll be able to take credit for those that you've retained under this new law. The deferral of the employee's portion of payroll taxes, okay? So in all honesty, I don't know how much this affects people because from our standpoint, you know, this was at the employer's discretion to do this. And what this was that an employee could come to an employer and request that their half of the employment taxes that they were paying, the Social Security tax rather, be deferred for the rest of 2020. And so if the employer agreed to do that, then the employee had certain time periods to repay that. Well, they've extended those time periods out through 2021 so that they have a longer time period to do that. Most of our clients that we talked to this about didn't want the responsibility of having to pay that tax back because it really was the responsibility of the employer, even though they were going to deduct it from the employee's paycheck. If the employee left, then they would have difficulty in collecting that money, et cetera, and having to repay them. So don't know if you actually did that or not, but there is a longer time period, which is good news for employees that did that because I think they had, you know, a shorter time frame, and so, you know, that's obviously less money in their pockets over a shorter amount of time. Here's a big one that's going to affect everybody. The meals and entertainment deduction has been changed once again. So now we temporarily have a 100% business expense deduction, but there's a caveat. Right now it's currently at 50%. The caveat is that the expense must be for food and beverages provided by a restaurant. And the key word here is by. It doesn't say in a restaurant. So we believe that like takeout and delivery meals, et cetera, that are provided by a restaurant will be fully deductible. So this is great news for all of us that have been for many, many years, only been able to deduct 50% or long ago it was 80%. So this provision expires through the end of 2022. So we got 2 years worth of, you know, deductions for meals that we can deduct. Now, once again, entertainment still non-deductible. They haven't changed that. That came out with the new tax Trump law. Okay, so a couple of other ones. Charitable contribution limits have been increased, and what that means is that typically for a cash contribution, you could deduct it up to 60% of your income. So if your income was $100,000, you could essentially give away $60,000 to charitable causes, and then be left with 40% of your limit of your income. Now they've increased that. It can be up to 100%. I don't know anyone that does that, but certainly those that are in that position and can do that, you can do that as well. They've also increased the limit of corporations. Typically, they were limited to 10%, and that was increased to 25%. And then finally, the health and dependent care spending arrangements. Okay, these are your FSA and dependent care spending agreements. Typically, I think an HSA or the medical savings account is $2,500, and then the dependent care, I believe, is $2,500 as well. And this is pre-tax money that goes into an account that you can then spend on pre-tax money. So instead of going to the doctor and paying for it out of pocket, you can have this health spending arrangement where you can have pre-tax dollars. Typically, those have been use it or lose it by the end of the year. A few years ago, they did change that and said, okay, we'll let you roll it over until March 15th. But now what they're saying is anything done in 2020 can be used entirely in 2021. And if you've elected a 2021 item, it can be used entirely in 2022. So for those of us who had to put off a surgery maybe that you expected and you put money aside for that and it didn't happen, well, now you're still able to use that money in 2021 without losing it and no penalty. I think that's it for the notable tax changes. So Suzanne, I'm going to turn it back over to you.
I think we're actually going to Andrew here to talk about first draw PPP loans. Any mods or changes there, Andrew?
No, all right, nope, that sounds good. Good afternoon, guys, and thanks for joining us. First draw PPP loans. So think about this as an extension of the prior program. So this is part of the EAA. It basically reopened the original PPP loan program, which had expired last fall, for new borrowing if you hadn't already taken advantage of it, or it opened it up for some new business categories. So we're going to talk about a couple of those things real quick. Not going to spend a huge amount of time on this because we figure it probably doesn't apply to most of you. But the first draw, and so the new act distinguishes between first draw and second draw loans. First draw loans are for people that haven't been in the program at all. So if it's available to new borrowers only, some borrowers may be able to revise or reopen existing loans, and we'll talk about that in just a second. As Suzanne noted earlier, the lending opened yesterday per the SBA. So when you get that email blast about, I had somebody call me today about, hey, I got an email that says the portal's open for new loans. Well, what that really means is the SBA's portal that the banks access is now open. As Suzanne mentioned, your bank, and we know a lot of banks are still not accepting loans yet. They're gearing up and will be probably opening up soon. And the program is going to run through March 31st. So you'll be able to borrow under the first draw loan program through March 31st. The qualification rules are essentially the same as they were. So you must qualify as an SBA, a small business, under existing SBA rules or have less than 500 employees. And there are some other general program changes, new expense categories, et cetera, that apply to both first and second draw loans. So we're going to talk about those just a little bit later. Suzanne, you want to jump over to the next slide? So business eligibility, new businesses. So this might impact a couple folks on the call today. So the Assistance Act opened up the PPP loan program to some new industries that had previously been barred from borrowing. So 501c6 organizations, for those of you who aren't in IRS speak, that's things like trade associations, chamber of commerces, et cetera. So those are typically nonprofit trade and organizations that were not eligible under the original program. They can now borrow under a first draw loan. Housing cooperatives, destination marketing organizations, and certain small public news organizations are now available for first draw PPP loans. So revisions and reapplications. As noted, that in addition to being brand new, some borrowers can come back in and revise their existing loans or their previous loans. And this could be important because if you have an opportunity to revise your existing loan, you may be required to do that before you would be eligible for a second draw loan. So if you're a seasonal employer, they changed the methodology for seasonal employers. We don't go into that a whole lot today. If you're a seasonal employer and want to know more about that, please don't hesitate to reach out. But if you're a seasonal employer who would now qualify for more money under the revised rules, you can reopen your loan. If you're a borrower who returned all of their original PPP loan, and we have some clients who did that. They borrowed it, they took a loan out, maybe got a little nervous or were concerned about some of the talk around the program early on and returned those funds. So if you borrowed and returned all your money, you can reopen that loan. Or if you returned a part of your original PPP loan, some borrowers did that. Also, if you did not fully accept, if you were approved for say $1 million and you told your banker, I only want to accept $750,000 in that, you can go back and reopen that original approval and get the additional $250,000. So those are a couple changes. Let's see, Suzanne, next slide.
I think we're going to me here on the second draw. So
maybe. All right. Yeah. So that's it on first draw loans.
Yeah, just to tie into what you were saying though, the first criteria for getting a second draw PPP loan is that you received a first draw PPP loan. So like Andrew was saying, if one of those items on the prior slide applies to you, if you didn't use your full amount or for whatever reason, you need to reapply for your first draw before you can get a second draw. So you have to, like the wording is important here, will or has used the full amount for authorized uses. So in order to get the second draw, you have to have gotten the first draw and spent all of your money, or are going to spend all of your money. So if you got it late in the game and you're still bleeding out your time period, that is part of the criteria for getting a second draw loan. They did reduce the number of employees eligible during the second draw. So as Andrew just mentioned, it was 500 on the first draw. So if you're getting the first draw loan, it's less than 500. But if you're getting a second draw loan, it is less than 300. So they're trying to target here more of the smaller, harder hit business. And as you can see by our third bullet here, you have to have at least a 25% reduction in gross receipts between comparable quarters from 2019 to 2020. And so again, this is intended to hit, more of the harder hit businesses. And so you might be wondering, well, I was not open for the first or second quarter of 2019, then, what do I do? And so you can compare any quarter. If you were just open for the fourth quarter of 2019, you can compare that fourth quarter to any quarter in 2020. And one other thing, I know Andrew kept wanting to make sure I noted this on this slide, but you will still qualify if your overall decrease meets this. So if your overall 2019 numbers are, if there's a decrease of 25% into 2020, that you will be eligible as well. And so I've gotten this question already from a few clients. How is this calculated? Is it calculated based on cash receipts, or is it calculated on accrual-based accounting, or how do they check it? What are they using? And so this is based, your revenue can be on the accrual basis. It will be on your method of accounting. And so if you do not, get interim financial statements, or you don't produce them internally, you can use your tax returns. And so whatever basis your tax return is on, you can use that basis. If you do your books internally on an accrual basis and are able to support that decrease in revenue, then you can use your internal books on the accrual basis. The other thing to note here, this is a little snippet on the screen of the application. And so there is a new second draw application form. It's 2483. And this is a little snippet of it. So if your loan is going to be $150,000 or less, you can leave these fields blank. However, you have to be able to prove it though. So you need to have those numbers when you do seek forgiveness. But initially, if you're like, hey, it's the 11th or the 12th of January, Suzanne, I don't know these numbers yet. How am I supposed to apply? If your loan is small, a lot of smaller businesses don't keep quarterly financials, or maybe they're not closed out for the year yet. That's okay. If you are pretty confident that you've had a decrease in revenue, you can go ahead and file, and then you've got, buy yourself some time to get those financials updated. But, just keep in mind that you do have to get them updated. So anything else on that, Andrew or Glenn?
Yeah, no, Suzanne, I was just going to point out that on the 25% reduction, so the reduction is written, as Suzanne mentioned here, a quarterly reduction, but there is then a follow-up note that says, as Suzanne mentioned, if your overall reduction for 2020 was 25% compared to 2019, you can just ride on that. You will be deemed to have met the quarterly reduction requirement. The catch there is that you have to be able to provide your tax returns with your application. So that's going to be, You know, in other words, they're saying if you don't have quarterly financials and can't prove it otherwise, you can prove just a year-over-year decrease, but you have to have your tax returns done. So if that's how you're going to demonstrate the 25% reduction, then you got to get busy and get your tax returns done and ready in time to submit your loan out.
Unless you're less than 150, right?
And there's no special
That's
provision from what I'm to understand about restaurants or anything like that on the 25% test. They still have to meet that 25% test. Everyone does. So
That's
even
correct.
if you're, you know, still operating, if you're closed your doors, but are operating, you know, for delivery and takeout only, and your levels haven't dropped 25%, you're not going to qualify.
Yeah, we're going to see this a lot, I think, for a lot of our healthcare providers that don't just, you know, didn't have a 25% decrease in revenue during the year. But yeah, Glenn, you're absolutely right. And, you know, on the $150,000 or less, you know, Suzanne, you're absolutely right. You don't have to provide those documents when you file, but you will have to have them and be ready to provide them with before you apply for forgiveness. So.
If you guys missed it, there was a guest appearance from Glenn's cat. It was not Joey, it was the other one, the fat orange one.
The orange one. That was Rascal.
Rascal, that's right. I should have remembered that. If you were looking alive, you caught that. So, all right, second draw PPP basics. As you know, we're talking about how do you get this loan and what is, you know, what's the criteria? We talked about that real quick. Is it the same? You know, do you get the same amount that you got in the first draw? So here's some of the rules for the second draw. So for most borrowers, cannot say that word right, needs a little asterisk for most, and we'll talk about what the alternative is to most in a second. It is still 2.5 times your average monthly 2019 or 2020 payroll costs. Here's the main difference is it is capped at $2 million. So the first draw PPP loan was capped at, I think, what, 10 million, guys? I can't recall, yeah. But this one is capped at 2 million. And so if you were one of the larger loans in the first draw, you will be capped during the second draw. But the calculation is primarily the same with 2.5 times your average monthly payroll costs.
Suzanne,
and so the most.
I was just going to say that the 2020 is new too, though, because for first draw PPP loans, it was the 12 months prior to the loan application or 2019. Most people took their average from 2019. Now you can take your average from 2019 or 2020. The assumption in the rules is that 2019 is still going to be the higher payroll year for most people, but it may not be in your situation. So just something to keep an eye on. Yes,
that's a good point there. And back to like the payroll costs, some of the rules there still apply, third bullet. So like salaries still have to be capped at 100K. You have to meet all the safe harbors and things like that. So those remain the same. If you don't remember those, again, 7 prior webinars where we talk about them. So we got plenty of information out there for you if you forgot, because I'm sure some of you did. So second bullet, if you are in the hospitality, accommodation, or food service sector, I believe the NICS code is starting with a 72 there. If you fall into that category, your loan can be 3.5 times payroll costs. And so again, they're trying to reach the hardest hit businesses, and obviously hospitality and restaurants were some of the most strongly hit. So they're trying to give them a little boost here and give them a little more. They are still maxed at $2 million, just like other industries. Covered period, the borrower can select any period, 8 to 24. This is not changing. Just want to point out here, you know, in the first round, we did have some people asking us, you know, what if I want to do 12, 14, 13, whatever. That's fine. It's anywhere between 8 and 24. So our advice is use up all your money and then, you know, look at applying. Don't apply early and, you know, give back some money if you don't need to. You know, try to use up all of your funds. And as we, you know, get further into this webinar, we'll be talking about allowable expenses. Most people can do it in payroll, but there are plenty of opportunities in expenses now to use up all that money. So pick a period in which you will be able to use up all that money. Also wanted to point out here, you'll note alternative covered period is eliminated in second draw, and that just simplifies it a little bit. I think they realized that was just kind of dumb, so they took it out. Loan proceeds must be spent on payroll and eligible expenses, which we'll get into. The same criteria applies to the second draw as well, as far as 60% of the proceeds must be spent on payroll. Again, we've got to go back to the intent of the bill. It's to keep people working. It's to keep, money out in the economy. So they're wanting people to spend this money on payroll. There are still no collaterals or personal guarantees, and the terms are the same as draw one, interest rates at 1% and a 5-year maturity. So a lot of the same things here. Anything to add, guys?
No, just keep in mind, those terms are only if your loan is not fully forgiven. Obviously, with the expanded covered period, the assumption is everybody should be fully forgiven.
All right, so getting into allowable expenses. As you can see, Woody here is ready to spend some money. He's got his PPP loan, he's ready to go. So first bullet here, we're not going to spend a ton of time on, just want you to know it's out there, cost of refinancing an SBA EIDL loan. We'll get into EIDL advances a little bit later, and those are different. So just keep that in mind. We will get into EIDL advances. So this is an important one because I already have a client who's spent quite a bit of money on some software in order to go remote. And so you can see here payments for any business software or cloud computing service that helps you keep going. If you were a retailer that didn't have an online presence and you had to close your doors, and so you spent a bunch of money to get an online presence and start taking online sales, that expense would be allowable under the new PPP loans. If you had to move your offices, your administrative support, your payroll, your HR, if you had to get them out of the office and home so that they could keep paying people, that's a function that's sometimes historically done in the office, and that's still sometimes very paper generated. If you went to a remote software, cloud software to let your people work from home, let them work remotely, that is all allowable under the new second draw loans. So important distinctions there. If you have any specific questions, of course, we could answer those for you on a specific type of software, but that's generally what it would include.
And Suzanne, I'll just point out for the things we're talking about right now, these are the expanded categories of expenses. Your standard categories are all still there. So payroll, rent, mortgage interest, utilities, those things still stand. These are kind of some of the buckets of expanded expenses that you're allowed.
Yes, thanks for clarifying that. The other ones are still there. These are just additional. So during 2020, as you all know, there was some crazy stuff happening and some protests that if you had any vandalism or property damage or looting due to any of that occurred during 2020 and your insurance is not covering it, that does also count as an allowable expense. The second bullet here are covered supplier goods. And so there's a couple words here to keep in mind or to point out. Obviously essential to the operations, that's very broad. The second bullet though, made pursuant to a contract order or purchase order in effect at any time before the covered period, okay? So if you need to get this second draw loan to cover, your 40%, you want it to cover some cost of goods sold or other expenses, other supplier costs, make sure to get those contracts in effect before you take control of the money. And so that word covered period, it says in effect anytime before the covered period. Before. So if you get the money on Friday, you better have that contract in place on Thursday, because Friday is when your covered period starts and Thursday is before. So just make sure you're reading that words correctly and that you're careful about that.
So Suzanne, I mean, that is a great point, because this is clearly there to provide, give providers some working capital. I mean, providers to give borrowers some working capital in case as they try to get restarted. So if you're buying stuff that is non-perishable, if you're a manufacturer and you need to buy steel or wood or cement, you need to have that contract in place before you get your loan. If you're a restaurant, you have a little more flexibility. If you're buying food supplies, because if it's a perishable good, it can be in effect at any time, either before or during your covered period. So a little bit of flexibility with perishable stuff, less flexibility with with non-perishables, but overall an expansion of the things you can spend money on.
Yeah, the other point I just remembered while you were talking was the first bullet where it says essential to the operations. Glenn pointed this out earlier, and wanted to make sure that this is to be used to maintain the operations of your business and not expand your operations. So just keep that in mind. If you're maintaining your operations versus expanding your operations, those are considered different. So keep that in mind. Now we're going to get into this allowable expense though, which could be, or I think maybe we already passed it. So this one is PPE equipment. So if you had to buy masks or filters or, filtration systems, anything like that to comply with CDC requirements during March 1st, 2020. And I don't know that this has ended yet. So if you're still trying to convert your business to get compliant, and this is the slide that I had it on, I apologize. So if you were, say, a restaurant that only had dine-in and you went to drive-through, this would be considered allowable under the new second draw loan. So if you had, again, a restaurant and you had booths separated by plexiglass or sneeze guards at the cashier, those types of things to make your business compliant, those would all be considered appropriate here.
Suzanne, I'll just point out real quick for our healthcare listeners that are on the call, if you've gotten money provider relief funds through the CARES Act, there may be some crossover here. So, you may be using some of those PPE costs or COVID related expenses to justify the use of your CARES money. If you spend PPP money on those things, you're not going to be able to use them for your CARES funds. So just keep that in mind. It's getting a little more complicated.
We're going to have a webinar on that too, just so you know. So I'm going to pass this over to Glenn to talk specifically about some of our registrants here that are Schedule C.
All right, thanks, Suzanne. And hopefully everyone is enjoying our Toy Story theme this week. We try to come up with something different, and lo and behold, I actually came up with a C there. So this is, Schedule C filers only. There's been a lot of questions about Schedule Cs, for a lot of different things. And so they really have tried to clarify some of these items for a Schedule C. So the first and foremost is that your PPP loan could affect your eligibility for unemployment and things like that. We haven't really seen any of that, but once again, that's some of the guidance that we saw. They are limited to eligible expenses that you previously had. So you can't, like Suzanne just said, this is not to expand your business, but to maintain your business. So if you had interest, rent, a vehicle lease, utilities, all of those things before the pandemic, then you can continue to pay for those after the pandemic and with these PPP funds. You can't use, for example, if you bought a new car or leased a new car or got a new building for rent or things like that that you didn't have before, then you can't use the PPP funds to pay those items. So once again, if you didn't have a car before, but you have a car now, then you can't deduct the gas for the vehicle, you can't deduct the interest on the vehicle or the lease on the vehicle. So that's really, one of those special things that we see for Schedule C filers. Once again, the operations, expenses, property damage, supplier costs, PPE stuff, all the things that Suzanne just went over, that all applies to Schedule Cs as well. And then finally, you are eligible for a second draw. We really, once again, you have to meet the criteria for the 25%. You have to meet the criteria for still being in business. You have to meet the criteria, for all of the other items, spending the previous loan, things like that. One of the key things and the key questions that I still don't have an answer to, but I believe what will happen is, how is this taxed to the Schedule C filer? If the Schedule C filer was, an S Corp, for example, and they were the only employee, then the PPP loan would be based on those wages, and you would be able to continue to still pay the owner employee. So I relevate that, correlate that to the Schedule C, and that yes, the receipt of the loan and the forgiveness of the loan is not taxable until you give it to yourself. And if you're using it to to pay yourself your wages, we believe that that's going to be taxable. So just kind of be mindful of that for those Schedule Cs, that's where we think it's going to fall out. But once again, we still haven't had a technical guidance on that. Suzanne, next slide.
Howdy, partner.
Gotcha. Partnerships. Okay, partnerships and partners. In fact, I've already got a question in the chat about this and how partnerships and partners work. At the very beginning of this, it was very confusing in how they define partners and partnerships. And this is LLCs that are treated as partnerships for tax purposes. So originally we thought since partners were self-employed that they would have to file on their own, but that was later found out and identified as not being the case, that the partnerships and partners file together. So how do you determine the amount of your PPP loan if you were going to go for a second round? It's the net earnings from self-employment that is on the K1 of the partner. So whether that's line 1, which is ordinary income, or guaranteed payments, both of those are considered net earnings from self-employment if you meet all the active requirements, etc. So that's first line. Now, of course, this is just for the partner portion of the PPP loan. You still have the normal. If you have employees and you're paying normal employees, you still have that calculation as well. This is on top of that. So then we reduce that net earnings from self-employment by any Section 179 expense. So that's a separately stated item. And then any unreimbursed partnership expenses, which is something very unique to partnerships, is that partners don't have to get reimbursed for their partnership expenses. They can deduct that directly on their Schedule E. So if you happen to be doing that, a lot of people don't do that anymore. I don't see that very often. But if you do, you would have to reduce that as well. So in calculating that, you would have to ask all your partners whether they're doing that or not. And if they are, then you would have to reduce your loan amount by that. Then what seems like arbitrary, multiplying this by 0.9235, where this comes from is on a 1040. There's a schedule for self-employment tax and calculating how much self-employment income that you have. And this 0.9235 comes into play, and that has to do with the deductibility of the taxes and things like that. So you got to multiply this by 0.9235. And then, of course, at the end of this, the result can't be more than 100,000. So whatever that number is, you would add to the number that you're calculating for all your employees on your average payroll. So that's really how partnerships and partners work. If you're going to apply for a second round, this is kind of the basic calculation that you have for partners and partnerships. Okay, so what's next? Certification. So we've heard a lot about this, and what we really want to stress here is that, I'm not going to read these, they're really small. There are certain certifications that you have to make in order to, be eligible for a new loan, okay? But what I want to point out is that the one that's not there is that lenders do not have to apply this if you have access to capital elsewhere test. So that was originally thought of as an issue for the first go around, but this has been specifically excluded. So for example, if you have great credit in your business and you could go out and get a line of credit for $3 million, then were you needing to have a PPP loan? This is not the case here. We don't believe that access to other capital through loans, et cetera, would apply in the certifications. So that's really, really good news. All right, Andrew, I'm going to turn it back over to you for some special circumstances.
Yeah, and I'll just point out that, I think one of the reasons for that initial access to capital was concerned that really large businesses were getting big loans, and now, you know, because they've capped the loan amount now at a fifth of what it originally was, that's how they're addressing some of those issues. So, all right, yeah, special circumstances. So these are just a couple things that we, you know, that the IFR, the combined IFR on the revised IFR on PPP and the second draw IFRs, those combined IFRs are over 120 pages if you read them together. So clearly we don't have time to get into all of that in an hour-long webinar. And so we just wanted to point out some areas where you should pay attention if you fall into one of these buckets. So if you're a seasonal employer, if you're a new business in early 2020, if you're a business in the accommodation or food services sectors, if you're self-employed or a partnership, if you're a farmer or a rancher, if you're part of a corporate group, you know, there are changes in the aggregate loan limits for corporate groups. There are some changes in the affiliation rules and the application of affiliation rules. These are all categories that you know, you may want to step back and dig a little deeper, get with your consultant. If you're potentially eligible for a shuttered venue operator grant. So these are special grants set aside for entertainment venues. So if you're in that line of business, you know, be aware that there may be a separate program out there. And if you qualify for that program, you're not going to be able to qualify for a second draw PPP loan. And if you're the U.S. president, vice president, head of a department of the executive branch, a member of Congress, or one of their spouses, you can't get a second draw PPP
We
loan.
can't confirm nor deny that any of those people have registered for this webinar.
Right.
So we thought we would
I heard that
in
Mike Pence is going to, but I really don't know. I wasn't, you know.
Yeah, we just wanted to be safe and include that because, you know, we're pretty high profile now, you know.
Yeah.
Exactly.
But yeah, all of these buckets, just be aware of these. If you fall into one of those buckets, you may have a special circumstance. It's worth reaching out and asking some questions. So required documentation for second draw loans. It's really very similar to the documentation for first draw loans. There's a new, as Suzanne showed you a little clip of earlier, there's a new loan application that's actually live and on the Treasury website. You can Google SBA 2438-SD and you'll get it. Your payroll documentation is basically the same. So if you're relying on 2019 and you're using the same borrower, the SBA says you don't have to resubmit. Now your lender may have different qualifications, but from the SBA standpoint, if you're just going to rely on your average payroll calculation from 2019, same one you relied on for your first draw loan, you don't have to resubmit all that to your bank. If you do have to resubmit, or if you're using a new lender, or if you're going to use 2020 as your benchmark year, you know, we're back to talking about your Form 941s, your payroll records, your 1065s or 1040 Schedule Cs, whatever it's going to take to document that amount that you're trying to borrow. For borrowers of more than 150,000, so we've touched on this already, you've got to document that decline in revenue. So you're talking about submitting financial statements. If you're going for the annual decline, you're talking about submitting your finalized tax returns. If you are borrowing less than $150,000, you fall in that bucket where you don't have to submit that information to document that decline in order to get your loan. Now, once again, we're going to see how all the lenders actually treat these requirements. But according to the SBA, you don't have to submit it at the time of the loan. You will be required to demonstrate, though, that decline at the time of forgiveness. Now, we're going to talk about some changes to the forgiveness application here in just a second, but you're going to have those records one way or another. All right, so next slide, Suzanne. All right, so changes to forgiveness. So we said we weren't going to dive into forgiveness too much, and we're not going to. The SBA has promised a new consolidated interim final rule on forgiveness. Note the future tense. It's going to be coming out at some point in the future. It's not out yet. But some things that we know. Loans of less than 150,000, and we keep talking about that number because that's a trigger point in the new act. Loans of less than 150,000 are going to be able to apply for forgiveness on the basis of certification only. Now, we're not sure exactly how this is going to interact with the requirement that you provide documentation to support a decline of more than 25%. It may be that all you have to do is certify that you decline more than 25% if you're under 150,000. Keep in mind that even if you don't have to submit a full application, or if you do have to submit a full application, the SBA is expecting you to keep your records for a period of at least 4 years, employment records for at least 4 years. All other documents you're going to have to retain for 3 years. And the SBA reserves the right to audit you, whether you're $2 million or $100,000. They always have the right to come look and ask questions. For if you're more than 150,000, the forgiveness process, as we know right now, looks like it's going to stay largely the same. You've still got your 2 applications, your easy and your long form application. We don't see a whole lot of changes there. Your 10K EIDL advances. So many of you may remember that you may have gotten a $10,000 EIDL loan or EIDL advance early on. And your bank may have, the SBA early on was deducting that from your forgiveness amount. Well, that's changed now. You'll actually, the SBA is no longer making you take your EIDL advance against your forgiveness. And so there's actually going to be a process that had guidance that was published, I think, 3 or 4 days ago, that the SBA is going to start refunding that. So if you had a first draw loan and you had your 10K EIDL advance applied against your forgiveness, the SBA is actually going to start reviewing all those loans, funding the banks, and the banks are supposed to turn around and actually stroke you a check plus interest at 1%. So just something to keep an eye out for on forgiveness. So, and with that, Suzanne and Glenn, I think we can go, and maybe we've got a few minutes. It looks like we can pick up some questions.
Yeah, Andrew, I think I've got a couple that, I've been answering in chat, but a couple of them I'd like to talk about, because a couple of people have asked, if for our first loan, if we didn't calculate it correctly. So for example, if we calculated too little, can we still get, a round 2? Or do we have to reapply for round 1 to get the full amount and then apply for round 2? I don't think the answer is whether if you calculated it incorrectly and it's too low for certain, then I don't think that you would have to go back and reapply to get the maximum amount. I think the only criteria is for whatever you did get, you did spend, and then you can go forward. Now, like Andrew said, or Suzanne in one of their slides, you can go back and try and maximize your loan, but you don't have to. And so I think that really becomes a strategy, because once again, you have time on your hands, in that even if you went back to do a reapply for a loan 1 and increase the amount, you still have to go through that spending process before you can apply for a loan 2. So just kind of depending on how that all works and timing and whether it's worth it or not, it's a consideration. I don't know if you guys have any kind of different view on that. What do you guys think?
I think you're right, Glenn. I mean, what we know, what the guidance talks about, the guidance talks in terms of people, of borrowers who received an original loan qualification or a loan amount and then did not use it, either because they returned it, they returned a part of it, or they didn't accept the full amount. You could have a situation where the seasonal employers, where you would have qualified for more under the revised rules, and maybe you're not going to qualify for a second draw loan because you didn't have the 25% decline. Well, then it would make sense to go in and reopen your loan. But otherwise, I think if you got the way I read the guidance right now, if you got the loan and you used your entire loan correctly, I don't think you've got to go back and try to maximize that loan. I think you're eligible for a second draw loan at that point.
Yeah, I would agree. And I think and that was my slide earlier, and it definitely, I may have confused it, but Andrew, that was a really good summary, I think, of what we believe it to be.
Yeah, another one, another good one here I have, she says, I have to buy supplies and materials to produce product for customers, or I send out to have it made. Can that be included as supply expense, although I do not have a contract? Andrew, you want to take that one?
Yeah, so the language they use is contract or purchase order or order. So I think, if you're getting a second draw loan and your intent is to use, you can use up to 40% of that loan for non-payroll purposes. If your intent is to use some of that 40% to buy supplies or materials or have some inputs made, if you go out and have some machining done or casting done that you use to produce final products, yeah, I think as long as you get that order in, as long as you get that order or purchase order, I would suggest, make sure you read the rule, look at this to understand it. But the way I read it, it doesn't have to be pursuant to a contract necessarily. It can be pursuant to an order or a purchase order that's in prior to the cover period.
Great. Okay, I've got another one that I've had two on this one. If I opened a business in April of 2020, would I be able to file for PPP 1 or 2? And the other one was actually September. If you open the business from scratch, so if it's a brand new business, then I think the answer is no. If you purchased the business from someone else and continued it, and they were in business as of, I think it was February 15th of 2020, then you could. And we have had clients that that's happened to. So you still have to follow those rules. Is it February 15th, Andrew?
It's February 15th. Yeah.
February 15th.
Yeah, you had to be in business by February 15th. Let's see, I think we got time maybe for one more.
Your cats, by the way, Glenn, really are into the PPP.
Yeah, they are. That's Joey.
Yeah, that's
I had to, all the doors in my house are removed. We're having them repainted. So that's why I can't close it and keep them out. So here's another one. I have a C Corp, been in effect since 1987. During the first PPP loan request, my company was approved for $45,000. I only requested a PPP loan that was later forgiven for $35,000. Can I request the $10,000 during the second PPP loan? I have $2,600 from the first round that was not spent. Can I use that during the second round? Okay, so there's a lot in there. And I think that $10,000 may come with EIDL. That's kind of what I'm thinking. Suzanne, you want to explain that? I don't know if we really touched on that very much.
sure, a little bit on one of Andrew's slides, I think. But if you did get the EIDL grant, it was $10,000, but you did not get forgiveness for it, the SBA is going through all of those loans to determine who got the grant, and they are refunding that money back to your bank. And so at this point, we understand that you don't have to do anything to get that $10,000 back. It will be coming back to you. We don't know a timeline, but once it's back to the lender from the SBA, then the lender will, of course, figure out who needs to get that money back, and they will pay it back to you. And I understand you will get 1% interest on however long it takes to get that loan back to you, or that amount back to you. But right now, I have had that question a lot. There's nothing we know of that you have to do to get that $10,000 right now, other than wait.
Right. And so the second part of that is really more troublesome. I have $2,600 from the first round that was not spent. Can I use that during the second round of PPP loans? Well, depending on what you mean by you haven't spent. Remember, it's not a dollar for dollar allocation. You don't have to put the money aside and spend it. So if you have a 24-week period, we are finding it very difficult for people to have not spent their money in the first round. So, that's really something that you have to look at. But if that truly is the case, if you are not able to spend it, even if, you go back and reapply some of these new rules and new things that we have for allowable expenses, if you haven't spent all that money, then you cannot get a round two.
Yeah, and Glenn, this was a Schedule C, right?
No, it was a C corporation. It was a company.
Okay. Yeah, I would agree. It would be hard. That's something you probably need to look at. Even if you set the money aside in a bank account, more likely than not, you've incurred sufficient expenses where you have documented the entire use of those funds, I would think.
Well, I see Jamie, so that means we are up on time.
As our time, it means we're
Our
out of time.
time clock has appeared to shut us down.
Just a subtle reminder, yes, we do want to be respectful of everyone's time here today on the call. And so we're right up on time here. And so we'll let you get back to your day, but we do want to close. A lot of questions that we did not even get to, and Glenn, I tried to take it easy on you. So we have probably about 30 questions that we're going to need to follow up with you guys offline on. So you'll expect a response from our team. Should you have questions that you didn't share with us today, please reach out to us. You'll see that email down below on the slide here, ppp@saltmarshcpa.com. Our team of 3 here is accompanied by several more, and they are really up to speed on these changes and want to help in any way that they can. So thank you for joining us today. Thank you, Suzanne, Andrew, Glenn, once again, for the time that you take to prepare for these. We really appreciate it, and we hope you all have a great day. We will be in touch. Part 9 is probably coming. So,
thanks, everyone.
Thanks,
Round
everyone.
9.